Though the future may be uncertain and unpredictable, firms must plan ahead if they are to realize their objectives and if they are to come to optimal operational decisions. That is the topic of discussion in this Openstax Chapter 18 for Finance, Financial Forecasting. Different stakeholders track how a firm is doing by reading and analyzing their financial statements. Internally, a firm's management owners want to make better operational strategic decisions. External stakeholders, consisting of creditors, investors, employees, government agencies, and the community in which it operates, have different objectives. Creditors want to assess the firm's ability to repay its loans. Investors want to assess whether the firm is fairly valued. Employees want to make sure their employer is a stable place to work. The government wants to assess compliance with laws and regulations. And the community in general wants to see if the firm is a good corporate citizen. Projections of a firm's financial health into the future allow these stakeholders to make good decisions. A firm's management owners typically have two forecasting horizons. The longer forecasting horizon is tackled by a strategic plan that encompasses several future years. An annual budget or operating plan represents a shorter-term plan. A balance sheet or statement of financial position shows the firm's assets or resources available to it to generate its revenues, profits, and cash flows on the left side, and its abilities and stockholders' equity, or the sources of its funding for the assets on the right side. A balance sheet reflects the firm's financial statement, standing at a point in time as compared to an income statement, which measures the firm's activity over a period of time. A historical balance sheet is usually extended into the future using analysis techniques. Trend analysis, ratio analysis, and common size analysis methods are the most used. An income statement consists of revenue and expense accounts and measures a firm's activity over a period of time. An income statement determines whether a firm has generated a profit or loss, i.e., whether it is profitable. Profits are defined as revenues being greater than expenses, whereas a loss is defined as expenses being greater than revenues. Intuitively, we know that profits are desirable for a firm. Firms that are not profitable need to be made profitable, as their long-term survival is at stake. Firms that are profitable need to maintain or improve that profitability. Projecting an income statement consists of projecting two principal elements, revenues and expenses. Trend analysis, ratio analysis, and common size income statement analysis methods are the most used. A sales forecast is the first step in creating projection. Sales are tied to a firm's level of activity, and therefore establishing this upfront is essential. Expenses that are directly variable to sales will necessarily rise when sales rise. Working capital elements such as receivables, inventory, and accounts payable are also related to sales activity. Longer-term, new fixed asset investments may be necessary to meet expansion plans, but have to be projected independently. Sales forecasts may be subject to seasonality. Sales forecasts are also subject to the economic environment and competitive pressures, as well as the firm's plan for dealing with these outside forces. How far back to go in using historical data to create a projection is not an easy question to answer. The best answer to this is it depends. Though we live in unstable and uncertain times, creating some kind of plan is better than having no plan at all. Contingency planning or having plan B in your back pocket might be the ultimate way to deal with this. The past is not always a reliable predictor of the future. However, it often provides the only information we have to base projections on. Historical trend, ratio, and common size data at least provide some insight into how our financial statements have evolved and the past relationships between our primary financial statement accounts. In the end, we need to apply judgment to the situation because things may change unexpectedly. For example, the COVID-19 pandemic is not something anyone would have predicted before 2020. Historical year-over-year sales growth can be useful in assessing longer-term secular sales growth. If underlying trends in the firm's markets are relatively stable, such information can be used to create forecasts. If inflation, the competitive landscape, and technological factors, to name a few, are radically different, these underlying sales growth trends may be unreliable, and a fresh assessment of a firm's sales trends will be needed. A firm's competitive environment must be assessed as a whole in order to forecast its future financial performance. Very rarely do firms face stable competitive forces and stable economic environments. The best laid financial plans require they not be made in a vacuum, but rather in response to projected changes to the economic environment and the firm's competitive positioning. The COVID-19 pandemic has brought with it supply chain issues, caused inflation in certain sectors of the economy, and exposed labor shortages. Planning for such a major disruption has not been easy for most firms. Pro forma financial statements, or future-looking financial statements, are an essential tool in managing a firm's cash flows and ensuring its survival and ability to attain its long-term objectives. Profits are not the same thing as cash flow. Firms don't fail because they aren't profitable, but because they can't pay their bills, which is a cash flow issue. A major purpose of pro forma financial statements is to identify gaps in funding in advance in order to be able to address them in a timely manner and before they bring the firm to a complete halt. Managing cash flow also ensures that a firm is on track as far as its long-term value creation objectives are concerned. A firm's value is dependent on its ability to generate free cash flow. Financial forecasts should be created for as long a period as is deemed to be forecastable. This is a subjective standard, not an objective one. Each firm must decide for itself just how far into the future it can project its results. In mature, stable industries that don't experience much change in the competitive environment or underlying economic factors, financial forecasts can be taken far in the future. In industries experiencing rapid changes in technology, taking forecasts out more than a couple of years might be a challenge. The creation of viable financial forecasts is dependent on the analyst's ability to draw upon all sources of relevant data to factor in the forecast: market mapping and competitive landscaping, an assessment of economic trends, a technology assessment, anything else that might possibly affect demand and pricing for the product, cost for resources, etc. We live in unstable and uncertain times, and whatever forecast you pull together will almost certainly be wrong. The key to dealing with this is to be ready to pull out a plan B. Also, one has to think about projections as a living, breathing document that should be brought up and redone frequently, not as a document to complete once a year and then put on the shelf to be dusted off at the start of the next year. A forecasted income statement starts with a sales forecast, as it projects the firm's level of activity for the year. The next step would be to layer in the expenses related to that sales forecast. Cost of goods sold are a primary expense. Other operating expenses generally fall into two categories: variable expenses, or expenses that vary directly with sales volume; fixed expenses, or expenses that don't vary directly with sales volume. The combination of the sales forecast and the expense forecast will then yield a net income forecast. The working capital portion of the balance sheet, specifically the accounts receivable and inventory sections, will mostly be driven by the sales forecast. Accounts payable, also a part of working capital, will be related to cost of goods sold, so the tie to the sales forecast is indirect. Accrued expenses and other payables can be projected based on a historical relationship with respect to total assets, or the common size balance sheet. Fixed assets on the balance sheet will be linked to the capital expenditure projection less accumulated depreciation. Depreciation expense for the year will be an input into the income statement. The remaining liabilities of the balance sheet, other than those discussed above, will come to be determined by the funding needs of the firm. It is also possible that shortfalls in cash flows will be funded by owners via capital infusions. The critical link between the balance sheet and the income statement is via net income and the statement of retained earnings. The critical link between the balance sheet and income statement is via net income and the retained earnings statement. There are other links such as depreciation expense and accumulated depreciation, but the above relationship is the most important one. As mentioned earlier in discussing balance sheet projections, revenue projections will drive projections for working capital balances on the balance sheet as well. The cash flow statement is composed of three parts: cash from operations, which is net income plus non-cash accounting charges such as depreciation and amortization, less changes in working capital. Cash for investing activities are essentially capital expenditures for new fixed assets, and cash from financing activities are funding provided by sources of capital, such as for debt and equity holders. The above describes the components of an accounting cash flow statement, i.e., as financial reporting will require it. This format is the indirect method for reporting cash flow statement. The alternative is the direct method. Once the cash flow forecast is pulled together, the critical part is in assessing gaps in funding, periods of time when the projected sources of cash are less than projected uses of cash. A firm that cannot pay its bills cannot pursue normal operations and must shut down. Suppliers will not deliver if not paid, the electric utility will pull the plug if not paid, and employees will not come to work if not paid. To avoid the shutdown scenario, it must either have adequate cash on hand or be able to tap lines of credit. The task is to identify how much is needed and for what period of time. A detailed and realistic projection of cash inflows versus cash outflows will reveal this information. With a couple of tweaks, the firm's projected accounting cash flow statements can be transformed into a projected free cash flow model, and a firm's value can be determined using the enterprise valuation model. This is a discounted cash flow method for valuing a firm. Projected free cash flows into a firm's forecasting horizon are lined up in a cash flow timeline and discounted back to the present day using a WACC, and then the present values are summed. The resulting sum is the enterprise value of the firm. By understanding the drivers of this valuation, firms can see the appropriate steps they can take to creating value. Spreadsheets are a great tool for facilitating financial forecasts. The income statement and the balance sheet are linked via the accounts on the balance sheet that are driven by sales and expense projections. The income statement and the balance sheet are linked to the cash flow statement. There is only one cash flow statement that can link the two statements. The most important link between the balance sheet and income statement is via the statement of retained earnings. Net income from the income statement feeds the retained earnings balance, and the balance sheet needs retained earnings to balance. There are other links, such as that between depreciation expense and accumulated depreciation. Then there are the links between the working capital accounts and the income statement, specifically the level of sales and the cost of goods sold. The working capital accounts affected are accounts receivable, inventory, and accounts payable. The link between the income statement and balance sheet works like this. Interest expense is the function of levels of debt of the company. Interest expense lowers net income. Lowering net income lowers retained earnings. Lowering retained earnings lowers stock equity. Lowering stock equity causes the company to take on debt to balance the balance sheet, but taking on debt raises interest expense. Raising interest expense lowers net income, and as you can see, the calculation goes around and around in a circular, iterative fashion until the level of debt needed by the firm converges on a certain balance. Thanks for watching and listening. Be sure to like and subscribe.